Welcome to Insights and Beyond, where we explore the facts behind the headlines and dive into the stories that matter. Today, we're tackling one of the most talked about topics in the financial world, cryptocurrencies. With so much information out there, it's easy to get lost in the noise, especially when myths and misconceptions are spreading like wildfire. In this video, we'll debunk 15 of the most common myths about cryptocurrencies and provide you with insights that experts might not be telling you. So, if you're considering investing or just curious about the world of digital assets, stick around. This video is packed with the information you need to make informed decisions. Cryptocurrencies have revolutionized the financial landscape, but with their rise comes a slew of misconceptions. These myths can be misleading, causing potential investors to either jump in blindly or shy away from opportunities. In this video, we're going to break down each myth, reveal the truth, and show you why understanding the facts is crucial before making any investment decisions. Myth 1: Cryptocurrencies are only used for illegal activities. Let's start with one of the most persistent myths, the idea that cryptocurrencies, particularly Bitcoin, are mainly used for illegal activities. This belief stems from Bitcoin's early association with the dark web and platforms like Silk Road, where users engaged in illegal transactions. The truth: while it's true that Bitcoin and other cryptocurrencies have been used for illicit purposes, this is not their primary function. In fact, according to a 2020 report by blockchain analysis firm Chainalysis, only 0.34% of all cryptocurrency transactions were associated with illegal activities. To put this in perspective, the United Nations estimates that 2% to 5% of global GDP, amounting to $1.60 to $4 trillion annually, is linked to money laundering in the traditional financial system. The transparency of blockchain technology actually makes it easier for authorities to trace and track illegal activities, contrary to popular belief. Myth 2: Cryptocurrencies are just a fad. Next, let's address the myth that cryptocurrencies are just a passing trend. Many skeptics compare the rise of cryptocurrencies to the dot-com bubble of the late 1990s, suggesting that once the hype dies down, so will the value of digital assets. The truth: while the cryptocurrency market is undoubtedly volatile, labeling it as a mere fad overlooks the long-term impact it's already had on the financial industry. Bitcoin, the first cryptocurrency, has been around for over a decade, proving its resilience through multiple market cycles. The total market capitalization of all cryptocurrencies surpassed $1 trillion in 2021, and continues to grow. Moreover, major companies like Tesla, Square, and PayPal have adopted Bitcoin, and the rise of decentralized finance, DeFi, and non-fungible tokens, NFTs, highlights the technology's broader potential. Myth 3: Cryptocurrencies are not secure. Another common misconception is that cryptocurrencies are inherently insecure. High-profile hacks and scams, such as the Mt. Gox exchange collapse in 2014, have fueled this belief. The truth: the underlying technology of cryptocurrencies, known as blockchain, is extremely secure. Blockchain transactions are decentralized, transparent, and immutable, meaning they cannot be altered once they're confirmed. The real security issues often lie with centralized exchanges that hold large amounts of users' funds. Hacks usually occur when these exchanges fail to implement proper security measures. By using secure wallets, such as hardware wallets, and only transacting on reputable exchanges, investors can significantly reduce their risk. Myth 4: Bitcoin is the only cryptocurrency worth investing in. Bitcoin often dominates the headlines, leading some to believe it's the only cryptocurrency worth considering. The truth: while Bitcoin is the largest and most well-known cryptocurrency, it's far from the only one with potential. Ethereum, the second largest cryptocurrency by market cap, is the backbone of decentralized applications, dApps, and smart contracts. Other cryptocurrencies like Binance Coin, BNB, Cardano, ADA, and Solana, Sol, offer unique features and use cases that differentiate them from Bitcoin. Diversifying across multiple cryptocurrencies can reduce risk and increase the chances of benefiting from emerging projects. Myth 5: Cryptocurrencies have no intrinsic value. A common argument against cryptocurrencies is that they have no intrinsic value, unlike physical assets such as gold or real estate. The truth: the value of cryptocurrencies lies in their underlying technology and potential to disrupt traditional financial systems. Bitcoin, for example, is often compared to gold as a store of value due to its limited supply and deflationary nature. Ethereum's value comes from its use in powering decentralized applications and smart contracts. The value of cryptocurrencies is determined by their utility, scarcity, and the demand from users and investors. As with any asset, their value is ultimately what people are willing to pay for them. Myth 6: cryptocurrencies are a bubble waiting to burst. The rapid increase in cryptocurrency prices has led many to believe that the market is a bubble that will eventually burst, resulting in catastrophic losses. The truth: while the cryptocurrency market is volatile and has experienced speculative bubbles, it has also shown resilience. The market has gone through multiple corrections, but each time it has rebounded and reached new highs. Increasing institutional adoption and regulatory clarity are signs that cryptocurrencies are becoming more mainstream and less speculative. All markets, including stocks and real estate, experience cycles of boom and bust, and cryptocurrencies are no different. The key is to approach them with the same caution and risk management as any other investment. Myth 7: governments will ban cryptocurrencies. There's a widespread fear that governments will eventually ban cryptocurrencies, rendering them worthless and illegal to use. The truth: while some countries, like China, have taken a hard stance against cryptocurrencies, outright bans are rare. Most governments are more focused on regulating the industry rather than banning it outright. In the United States, for example, cryptocurrencies are legal, and regulatory agencies like the SEC and CFTC are working on frameworks to govern their use. Countries like El Salvador have even adopted Bitcoin as legal tender. The trend is toward regulation that protects consumers and integrates cryptocurrencies into the broader financial system, rather than outright bans. Myth 8: cryptocurrencies are bad for the environment. The environmental impact of cryptocurrencies, particularly Bitcoin, has become a hot topic, with critics arguing that the energy consumption required for mining is unsustainable. The truth: it's true that Bitcoin mining consumes a significant amount of energy, but this is only part of the story. According to the Cambridge Center for Alternative Finance, Bitcoin's annual energy consumption is comparable to that of a small country like Argentina. However, a significant portion of this energy comes from renewable sources. Additionally, the development of more energy-efficient consensus mechanisms, such as proof of stake, polonium-2 sulfide, is addressing these concerns. Ethereum's transition to POS, for example, has reduced its energy consumption by over 99%. The energy use of cryptocurrencies should also be weighed against the environmental costs of traditional banking and financial systems. Myth 9: you need to be a tech expert to invest in cryptocurrencies. Many people are intimidated by the technical aspects of cryptocurrencies and believe that you need to be a computer scientist or blockchain expert to invest in them. The truth: while understanding the basics of how cryptocurrencies work is important, you don't need to be a tech expert to invest. There are many user-friendly platforms, such as Coinbase, Binance, and Kraken, that make buying, selling, and storing cryptocurrencies accessible to everyone. These platforms often provide educational resources and customer support to help new users. Additionally, there are financial advisors and services that specialize in cryptocurrency investments, making it easier for people to diversify their portfolios without needing to master the technology. Myth 10: cryptocurrencies are unregulated. The notion that cryptocurrencies operate in a regulatory vacuum is a common misconception, leading some to believe that the market is a lawless, wild west. The truth: while it's true that the regulatory landscape for cryptocurrencies is still evolving, they are far from unregulated. In the United States, for instance, cryptocurrencies are subject to various regulations under the jurisdiction of the SEC, CFTC, IRS, and other agencies. These regulations cover everything from taxation and securities laws to anti-money laundering, AML, and Know Your Customer, KYC, requirements. Globally, countries are implementing their own regulatory frameworks to ensure that cryptocurrencies are integrated into the financial system in a way that protects consumers and prevents illicit activity. Myth 11: cryptocurrencies are a get-rich-quick scheme. The meteoric rise of Bitcoin and other cryptocurrencies has led many to believe that investing in them is a guaranteed way to get rich quickly. The truth: while there have been instances of people making significant profits from cryptocurrency investments, there are just as many stories of people losing their investments due to market volatility, scams, or poor financial decisions. Cryptocurrencies are high-risk assets, and their prices can be extremely volatile. Anyone looking to invest in cryptocurrencies should do so with a long-term perspective and be prepared for the possibility of significant price swings. Diversification, thorough research, and a clear understanding of one's risk tolerance are key to navigating the cryptocurrency market. Myth 12: all cryptocurrencies are the same. A common misconception is that all cryptocurrencies are essentially the same and that they function in the same way. The truth: there are thousands of different cryptocurrencies, each with its own unique features, use cases, and value propositions. Bitcoin is primarily used as a store of value and medium of exchange, while Ethereum is known for its smart contract functionality and decentralized applications. Other cryptocurrencies, like stable coins, e.g., USDT, USDC, are pegged to fiat currencies and are used to facilitate transactions and reduce volatility. Some cryptocurrencies, like Monero and Zcash, focus on privacy and anonymity. Understanding the differences between various cryptocurrencies is crucial for making informed investment decisions. Myth 13: cryptocurrencies are anonymous and untraceable. The idea that cryptocurrencies are completely anonymous and untraceable has contributed to their association with illegal activities. The truth: most cryptocurrencies are pseudonymous, not anonymous. While transactions do not directly reveal personal information, they are recorded on a public ledger, blockchain, that can be traced. Law enforcement agencies have become increasingly adept at tracking cryptocurrency transactions and identifying individuals involved in illegal activities. In fact, blockchain analysis has been used to solve crimes and recover stolen funds. Privacy-focused cryptocurrencies like Monero offer greater anonymity, but even they are not completely untraceable, as advancements in blockchain forensics continue to evolve. Myth 14: cryptocurrencies will replace traditional money. Some enthusiasts believe that cryptocurrencies will eventually replace traditional fiat currencies, leading to a decentralized global financial system. The truth: while cryptocurrencies offer an alternative to traditional money, it's unlikely that they will completely replace fiat currencies. Governments have a vested interest in maintaining control over their national currencies, and central banks play a crucial role in economic stability. However, cryptocurrencies can coexist with traditional money, offering an alternative for those seeking greater financial autonomy, privacy, or access to global markets. Central bank digital currencies, CBDCs, are also being explored by various countries, blending the benefits of digital currencies with the oversight of traditional financial institutions. Myth 15: it's too late to invest in cryptocurrencies. With Bitcoin's price skyrocketing in recent years, many people believe that they've missed the boat and that it's too late to invest in cryptocurrencies. The truth: while Bitcoin's price has increased significantly since its inception, the cryptocurrency market is still in its early stages. There are still many opportunities for growth, particularly in emerging projects and technologies within the space. For example, the rise of DeFi, NFTs, and blockchain-based gaming has created new investment opportunities beyond just buying and holding Bitcoin. Additionally, the increasing adoption of cryptocurrencies by institutions and the development of regulatory frameworks suggest that the market will continue to evolve. As with any investment, timing is important, but it's never too late to start exploring and learning about the opportunities in the cryptocurrency space. A look ahead: the future of cryptocurrencies. As we debunk these myths, it's important to consider what the future holds for cryptocurrencies. The landscape is rapidly evolving, with new technologies, regulations, and market dynamics constantly emerging. Here are a few trends that could shape the future of the cryptocurrency market. 1. Decentralized finance, DeFi. DeFi is revolutionizing the financial sector by providing decentralized alternatives to traditional banking services. From lending and borrowing to insurance and derivatives, DeFi platforms are enabling users to access financial services without the need for intermediaries. As the DeFi ecosystem grows, it could challenge the dominance of traditional financial institutions. 2. Non-fungible tokens, NFTs. NFTs have gained popularity as a way to represent ownership of unique digital assets, such as art, music, and virtual real estate. The NFT market has the potential to expand beyond digital collectibles into areas like intellectual property and real-world assets, opening up new avenues for investment. 3. Interoperability. As the number of blockchain networks increases, the need for interoperability between these networks becomes more critical. Projects like Polkadot and Cosmos are working on solutions to enable seamless communication between different blockchains, which could lead to greater efficiency and innovation in the crypto space. 4. Institutional adoption. The increasing interest of institutional investors in cryptocurrencies is a sign of the market's maturation. Companies like MicroStrategy and Tesla have made significant investments in Bitcoin, and more institutions are expected to follow suit. This trend could lead to increased liquidity, reduced volatility, and greater acceptance of cryptocurrencies as a mainstream asset class. 5. Regulatory clarity. As governments around the world continue to develop regulatory frameworks for cryptocurrencies, greater clarity is expected to emerge. Clear regulations will provide more certainty for investors and businesses, potentially leading to increased adoption and innovation. To conclude, the world of cryptocurrencies is complex, dynamic, and full of potential. By debunking these 15 myths, we've aimed to provide a clearer understanding of the realities of the crypto market. Whether you're a seasoned investor or just starting, it's crucial to stay informed, do your research, and approach the market with a balanced perspective. Cryptocurrencies are not a get-rich-quick scheme, nor are they a fleeting trend. They represent a fundamental shift in the way we think about money, finance, and digital ownership. As with any investment, there are risks involved, but with the right knowledge and strategies, there are also significant opportunities. As the cryptocurrency landscape continues to evolve, staying informed and adapting to new developments will be key to navigating this exciting and sometimes volatile market. Remember, the most successful investors are those who are willing to learn, question assumptions, and stay ahead of the curve. Thank you for watching, and if you found this video helpful, please like, subscribe, and hit the notification bell to stay updated on all things crypto. Until next time, happy investing!